silver has just been classified or reclassified as a critical mineral.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money. And, Live from the Vault is the show that goes way beyond the headlines to uncover the truth about the precious metals industry. And joining us today is Kinesis' very own renowned whistleblower and precious metals industry expert, Mr. Andrew Maguire. And this week, we'll be answering more questions from you, the Live from the Vault community. Thank you so much. We got so many questions that we just can't keep up. But keep those questions coming in. And all you got to do is just look down below, click on the link, and you can record in your own voice. And you never know, Andrew may just answer your specific question. And so let's head over to the UK right now and talking gold with Andrew Maguire. All right. Hey, Andrew, I got to start off here by saying, wow, this is amazing. Back in, I remember as early as the first episode of 2025, you had been calling, watch the third quarter. By the end of the third quarter here in 2025, your target was 3,800 for gold, and it was hit not close. It was hit right on the nose, and that prompted a lot of questions as to what to expect from the fourth quarter to the end of the fourth quarter, end of the year here as we begin the fourth quarter. And, I just want to mention that you had also mentioned many times that gold is going to go into your long-standing target of $4,500. That's just amazing. So we've got a lot of questions like I had mentioned, and let's go right into Lawrence's question because he's got so much in his question there that I think we're going to have almost a whole episode dedicated to Lawrence's questions here about what's happening.
Hey, great to be with you, Shane. Yeah, I mean, I can't believe the amount of really, bang on questions, really salient questions. I think we chose Lawrence because it just simply covered so much stuff. And I think, as you say, there's a lot of questions buried within that very cleverly put together questions. But yeah, that's rock and roll.
All right, let's go right over and let's hear from Lawrence in his own voice. Go ahead, Lawrence.
Hi, Andrew. Lawrence here. Thanks for last week's episode where you gave a scenario where either there's a Treasury revaluation of gold or the Fed and its agent banks will receive a massive bid-only margin call. On the first hand, gold seems to be doing a good job of revaluing itself these days, and I would imagine the Treasury would only revalue gold if they were forced into doing so in light of the massive undeclared reserves of the BRICS nations, notably, China and Russia, and the advantage this would convey to these countries. On the second hand, it's not inconceivable that the Fed would simply stump up the 3.5 billion come a margin call, and in the meantime, they subtly exit their short positions at the agent banks. So what's more of concern for me is the more or less 1.1 trillion of gold and silver derivatives in those opaque OTC markets. A revaluation would surely implode these positions, causing major financial turmoil. So does this then make it more likely that we would see agent bank bailouts via the Fed rather than a more immediate gold revaluation? And can you give your take on the current situation with the status of gold and silver in these over-the-counter markets? Many thanks.
Yeah, great question, Lawrence. And let's start by really looking at exactly who is on the hook here. The banks, along with the Bank of International Settlements, are all long for their own books. We've established that a long time ago. The only banks that are naked short gold are actually the banks that stick handle the Fed's short gold position. So it's important to understand that. No bullion bank is short for their own book. So what is it? It's the Fed. That's the only central bank still exposed to a net short derivative book. And while this is transparently evident in the hard-to-hide COMEX futures market footprints, where we can tie auditable monthly Fed repayments back to the BIS, as we have in every single episode we've tracked the Fed being actually forced to buy back their short-sold lease borrowings into a series of higher prices. Now, it's the larger over-the-counter naked short unallocated bets in the OCC report that you refer to, which is where the real gold derivative problem actually lays. Now, every well-connected physical facing liquidity provider we deal with backs up our assertion and well-founded empirical evidence that these very, very large, undeliverable, unallocated OCC gold bets. And remember, OCC just simply means the report that the Office of the Comptroller, and we've shown how suddenly the 5-year and longer bets were starting to be cut down, which told us, it was just one more thing that told us someone wanted to get out of Dodge. And so really, and it's these bets that are still outstanding is all that remains to so-called hedge these rehypothecated double ownership claims on a yet unknown percentage of the 8,133 tons of US Treasury gold. Or put another way, yet to be repaid US Treasury lease positions. We'll drill into the detail of how vulnerable to a forced gold revaluation this presents the Fed. And we're going to do that shortly, but the far more visible COMEX futures positions. Now, this is the spot market. So let's look at the futures market, which is really apples to apple. Every single month, we evidence how deep a hole the Fed has dug. Now, this is best demonstrated by the sequentially higher end of month and now yesterday's here end of third quarter mark-to-market event. This time, despite a massive effort to rinse out as many spec longs as possible into yesterday's end of quarter, we saw an attempt to rinse out. So basically, to try and mark that down, the bottom line is the Fed was forced to buy back deeply underwater gold leases at exactly $409 per ounce higher than they could last month. Now, given there's still 30 tons to buy back at market, it will drive the offer price to sell gold even higher. So if I'm a seller, I'm going to, and I see this demand coming through, then I'm going to raise that price. So currently this 30 tons is knocking on the door of $4 billion. That's just to square these smaller futures bets. But this size of at-market physical buying will once again reveal the buyer as the Fed, which brings us back to our assertion that a forced gold price revaluation is imminent. Now, the problem for the CME LBMA cartel is that the Shanghai Exchange International vaults are attracting legacy institutional ETF and physical flows out of Western control, skewing leverage futures overbought conditions versus underbought physically backed gold demand, and it's exacerbating this widening gulf. Now, Deutsche Bank's deep dive analysis here picks up on why ETF demand is outperforming all the legacy models that indicate overbought conditions. Now, what's not addressed is that the large-scale institutional EFP demand comes off a base where most of these ETF investors are buying gold off a zero investment position. They've never been exposed. They'd have no gold in their portfolio. They are starting out. This is huge. And obviously they're having to buy into the current physically determined Shanghai Gold Exchange benchmark positions. They face the Shanghai international side of that market. Now, hence, in this link, the aggressive interpretation. Also, as we'll look at, China has really cornered the gold market completely, stealing ETF investment flows out of the LBMA CME price setting machine. this very sticky physical gold demand is very supportive of higher prices. Now that brings us on to Lawrence's question as to where are we with the gold price revaluation process that moved onto the front burner in January 2023. As we know, after the BIS reclassified gold as a high-quality liquid asset on the 1st of January 2023, every single global central bank, bullion bank, alongside fresh sticky inflows of institutional exchange-traded fund gold, followed the BIS lead and moved to go long gold, leaving only one central bank short gold, the Fed. So by November 2024, the Basel III effect had really begun to take hold. And we're going to look at how they attempted. This was the last kick at the can right here. And we'll go through that in a little while. But what happened was the CME, the House, raised, and bear in mind a lot of specs had come in here as well. They raised margin limits, i.e. the amount it costs to borrow gold from the House. They raised it. And of course, because there was a lot of leverage longs, bang, down it went. Now, I'm going to look at that in more detail in a minute, but keep that in mind, because while it enabled the House to flush out the non-sticky speculators open interest element, there was far too much competing T+1 physical gold buying interest, limiting the scope to short cover. Now, this would have, in the past, been a significant smack lower. So, drilling down, as we just evidenced yesterday, Tuesday, and into the end of the first quarter, the third quarter, it is always constructively healthy to regularly eject the spec froth the House can one-to-one short cover against with impunity. Now, while the end of the quarter selling was 100% related to official Fed BIS end of month, end of quarter mark-to-market event, which we marked here on the longer term chart here, in comparison, what we saw was very limited. The scope of the selling is limited literally to the number of fresh spec long stops that can be equitably rinsed out without digging a deeper hole, because there's a physical market attached. And this raises a couple of questions on a short-term basis. Now, given the Chinese Golden Week holiday starts today, October the 1st, and reopens next Thursday into so-called technically overbought conditions, paper market conditions, that is. Now, we may see some similar paper market efforts to end into the end of this week, which is non-farm payrolls. Actually, that may not be released due to the government shutdown. But given China has cornered the bullion markets and that the PBOC will not be on holiday, expect late to the table Western institutional ETF investors, exchange trade fund investors, to continue to buy every single dip. The only question is, where's all this bullion going to come from to meet this fresh demand? Across the board, institutional investors have only have exposed themselves to less than 0.5% of their assets. And if they added 1%, it would be 20 or 30 tons. And that's conservatively speaking. So, by the way, while there will likely be no non-farm payrolls report due to the government shutdown, Bloomberg has all the same data as the Fed, so there will be a release of some sorts. So, in summary, it's the Fed that's on the hook for the remaining asymmetrically imbalanced short bets against gold, and having no physical bullion to back up those short bets, and having not anticipated that the COMEX has been forced to become a price taker, the only solution is to once again buy back this borrowed gold at the market price ahead of an impossible to avoid gold price revaluation. And as we just evidenced, currently this will cost them over $400 an ounce, more than last month's BIS repayment. Following a good deal of healthier skepticism around our assertion that the Fed must revalue gold, it seems we're not alone anymore in assessing it for all the same reasons we previously outlined, as picked up for the first time here by Bloomberg on Monday, and also picked up by Zero Hedge alongside other mainstream media publications we're not going to bother to dig into at this point. As we summarized in our last episode, this relentless bricks gold demand has driven the legacy paper market into an impossible to maintain divergent inflection point that can only be resolved by one of two events: a massive bid only T+1 margin call, meaning it's going to be delivered right away. That can only be resolved. So either that way, and that's would spike gold, as we said last time, thousands of dollars higher, or, of course, much more equitably resolved by a more orderly US Treasury gold price revaluation. Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside the CME LBMA ring fence, the stealthy gold revaluation process that commenced directly after the Bank of International Settlements revalued gold as a first-tier high-quality liquid asset on the 1st of January 2023 has gathered sufficient momentum to force the US Treasury gold to be revalued. There it is. You can start to see it. And as we've been drawing attention to, every single non-dollar denominated fiat gold price has led dollar denominated gold into all-time highs. So every other gold price in every other currency has been making new highs long before dollar price was dragged higher. But as we've been focusing on, the real game changer is that China took the gloves off the moment that yuan gold became fully Basel III compliant, followed by opening up Western-facing institutional-grade gold trading and vaulting facilities, which eliminate unallocated gold counterparty risk. Hey, no-brainer there. And with that in mind, and obviously you need the right liquidity to do that, but with that in mind, with the SGE market holiday coming up, now there is a market holiday, and it starts today. What we'll do is we'll answer some questions on the risks associated, because I had some questions on this too, with the shorter term so-called overbought gold and silver positioning. We've done a lot of comments about this so-called overbought situation. Now let's start with a quick summary of the last episode of this, again, so-called overbought paper versus physical action, into the upside breakout as well in silver, alongside healthy consolidation action in gold, which all this time has actually constructively been coiling gold into this week's all-time highs, and silver coiling right under it. And what continues to be missed by wrong-footed analysts touting this so-called overbought condition is that the last $1,300 rally in gold from $2,600 in January and the $15 rise in silver from $32.75 from the end of May is what it is. It proves there are some solid gold rails between the legacy LBMA CME derivative market, paper market, versus the physical market. And they finally crossed. There was a junction. It changed. They're in the rear view mirror. And what it's done is force these once dominant price setters to become price takers. Now, the shorter term footprints reveal these legacy actors operating in current so-called overbought market conditions. They're unable to find sufficient leveraged COMEX open interest, paper chips. Remember, chips borrowed from the house. They've been unable to find enough to be able to ignite the sort of historical wash and rinse cycles which so many people thought would never, ever end. And because it's forced them, as I say, to become price takers into a series of ever higher margin calls, hence limiting the scope to ignite historical sell ignition, which is something that you could easily do. Just keep taking the short side of every buy, knowing they'd never take delivery, and then ring the register. And essentially, that although that still stays in place, it's such a small degree, there's not enough power to cause any problem. So as we continue to anticipate these paper-driven dips, and we've been saying this all along, they are and will be very shallow. Each short-term cycle is discovering the next in a series of higher physically supported stair steps to rally up from. Now let's briefly take a look at current conditions and how that provides clues of upcoming prices. And let's start by looking at gold, which is increasingly coming into the generalist mainstream media market focus. Bloomberg is increasingly onto the change in market behavior, while still not waking up to the overbought conditions are actually being driven by the transparent Basel III compliant Western-facing Chinese physical exchanges, which are permanently attracting untrusted, unallocated CME LBMA business into their trusted vaults. This next Bloomberg article last Tuesday really threw the cat in amongst the pigeons, driving a fresh flows of local London into highly liquid, global-facing SGE hubs. This is China taking off the gloves. So as you can see, China aims to become custodian of foreign sovereign gold reserves to strengthen its standing in the global bullion market. So it says the People's Bank of China is using the Shanghai Gold Exchange to court central banks in friendly countries to buy bullion and store it within their country's borders. We knew this. The move would enhance Beijing's role as the global financial system, really in the global financial system, furthering its goal of establishing a world that is far less dependent on the dollar and Western centers. However, what I find somewhat amusing, I might have to chuckle here, is that this apples to oranges World Gold Council comparison view that, quote, gold trading volumes in London still dwarf Shanghai, completely miss the fact that the SGE volume is 100% physically backed versus local London counts unbacked, unallocated gold settled amongst the LBMA member banks' books. So a more realistic comparison would be to discount the LBMA's plus or minus 600 tons cleared every day by the allowable 20% haircut, which is completely allowable for them, which equals about 480 tons. But compare that against the plus or minus 500 tons of fully backed international facing SGE gold cleared every single day. The international hub is averaging plus or minus 450 tons of gold settlements, adding significantly to daily volumes cleared. And the SGE vaults are being stuffed with Western bullion and are setting the global prices. Now, drilling down even further, illustrating the SGE has now overtaken local London as the global price setter, the relatively small 3 to 5 tons of Basel III compliant London spot gold that settles at the fixes is actually dwarfed by the 15 to 50 tons of SGE gold physically withdrawn every day. Now, recently, we've evidenced these volumes ramping up fast, hitting record volumes as high as 53 tons entering warehouses at the end of the day. This gold is flowing into China at the expense of the legacy cartel. Now, these footprints illustrate that the SGE global bullion trading hubs have become sufficiently liquid to discover two competing institutional grade Basel III compliant physical fixes. That's Beijing time 10:15 a.m. and 2:15 p.m. That enables the diluted local London twice daily fixes to be one-to-one arbitraged as a benchmark. Now the clues are all there. Each Asia buys physical COMEX sells paper session, and we see multiple examples of it. AM fix versus a PM fix. Now, we have seen some change in behavior, but usually it is Asia buys and the West sells. And again, we've seen, although we see a break in behavior here, it's simply because the shorts got squeezed more than they could cope with. And again, we see a new high being made today, Wednesday, and then the PM fix coming in lower. All that does is set up China for Asia to set up a bid-only situation, which we saw after the sell-off. Okay, so China's on holiday, but the PBOC certainly is not. And as I say, ETF demand will not stop. It's only just begun. Now, let's look at why CME margins, meaning the cost to borrow 100 ounces of a gold contract from the house, currently is $17,000 per contract. Now, let's look at why they have not raised these margins from a value of 280,000, which is 6.07% of the value of 280,000. And why? And I haven't even marked the latest highs here. I just recorded this yesterday. That was 390,000 per contract value. And the CME margin was still only 17,000, which is only 4.3% of the value. Now that raises the question, why have the CME, essentially, why has the CME not raised gold borrowing margins into the subsequent, now bearing in mind that we talked about how speculators buy and you want to knock them back down, you want to untake with impunity add short positions against them, and then raise the margins, and they're so leveraged, they simply have to sell. Beggars the question, what's different now? So the post-Basel III gold first-tier reclassification on the 1st of January 2023 had driven a 970 rally from 1,830 into the 1st of November 2024 at 2,800, prompting the CME to raise GC borrowing margins on that day. And this margin increase, as I say, targeted heavily leveraged longs who'd borrowed gold from the controlling COMEX cartel, triggering a 2-week $260 sell-off. As I say, why has it not raised since? Because you're talking a $1,300 gold price appreciation, which just this week has just tagged pretty close to just over 3,900, lowering the cost to control 390,000 of positions to just 4.3%. Now, to put that into context, these unallocated GC contracts, gold futures contracts, are currently leveraged at a massive 96 ounces of paper to 1 ounce of gold. The answer is simple. While gold was equally overbought, and look, it was equally overbought back in November 2024, there was still sufficient heavily leveraged speculator open interest for the house to target to short cover these one-to-one shorts they'd placed against these specs. However, now it's the legacy shorts that are vulnerable. Hence, against all the pressure to raise margins, the house has resisted raising them. Given the pressure that this is so blatant and there are questions, so it may happen, but net of the current healthy long stop rinses, if you raise them now, the longs have a lot of ability to absorb a margin call because they've got a lot of padding under their positions. It's the shorts that would be vulnerable to a small rise in borrowing costs, as it would really literally force them to short cover. Shorts are stretched.
All right. Hey, Lawrence, thanks so much for that question. And there have been many, many other questions. But, Andrew, the next topic that came in, a lot of questions about what are you seeing for the silver stackers that are doing the shimmy or the dance now. I think they're pretty happy at what's going on with silver.
Shane, every time I see you, mate, I see silver in your eyes. I actually see that. So, yes, let's have a look at that. For all the same reasons, silver futures margins have not been raised to protect the very large naked officially short bets against silver. Now, with COMEX now reduced to becoming this price taker, the only solution to buy this silver back at market is to buy it back at market. But hey, Houston, there's a problem. Isn't that a saying? Houston, there's a problem. Silver has just been classified or reclassified as a critical mineral. Now, into really very, very escalating geopolitical and tariff escalations, it's in very strong Russian and Chinese military demand. Now it's in US demand. I mean, basically, that's why we're noting record prices in every single global foreign exchange currency cross, prompting the US to both accumulate, and the word is soon to ban exports of US silver. There's only one outcome to tightening supply. The offer to sell silver for immediate delivery is simply going to rise. Let's look at a similar look at the silver futures structure. For all the same reasons, they haven't raised margin calls. And you think about it, take a look at this, which is a protection of very large, naked, official short bets against silver. And with COMEX now reduced to becoming a price taker, the only solution is to buy this silver back at market. As I say, here's the problem. And as we just noticed, silver's just been reclassified as a critical mineral. And with it in accumulation with Russia, China, and the US has just begun, probably likely this export ban is almost certain. As I say, there's only one outcome to tightening supply. The offer to sell silver for immediate delivery simply has to rise. So at a contract value of 165,000, and this was the same period, 2020, when they raised margins on silver to 16,000. Again, we saw a bit of a smackdown there. That was 9.7% of the 165,000. It's still 16,000, and we've actually moved higher now. So basically, even though it's slightly higher now, there's still 6.7% of contract value, which is a hell of a lot less. Now, shorter term, as silver broke out above the identified short stops at 44,275, if you remember, we circled this. I've now added a color to that circle, but this is where the circle is, as is this circle at 53. But essentially, it broke out last Thursday. Then we saw UBS belatedly updating their silver spot price to between 44 and 47 per ounce, stating it would bring it in line with their upgraded 3,900 gold forecast made a couple of weeks ago. They also reaffirmed their intention to stay long and would view all pullbacks as buying opportunities in both gold and silver. Interestingly, while they listed all the usual geopolitical industrial tailwinds, fiscal deficit and de-dollarization drivers, the pivotal critical mineral reclassification, and the G7-driven global stockpiling agreements were completely missed. Also, G7 began to weigh in price floors for counter China's dominance. So in summary, what this means is that dollar price silver is grossly underpriced versus at the highs in every other currency, led by daily fresh XAG CNY. In other words, silver against the CNY cross, the Chinese cross. It's being driven by Chinese physical stockpiling. And you can see that this is where it's being led from. So silver price floors are being put in place with CME LBMA diluted dollar price silver in the crosshairs for delivery. Now, the consolidative long stop rinsing in silver is healthy. It's just healthy as it takes out low-hanging layers of cell ignition, like people who've borrowed silver from the house, and they've borrowed just about enough to create some cell ignition, but really it's very low-hanging because there's very little of it. Also, everyone is aware of the Fed wrong footing and are once again looking to capitalize on any dips that are offered. Now, following meetings with our Chinese-facing liquidity providers, they report fresh Western institutional gold and notably very large silver demand following the end of session we saw the pit. We saw a pit close. We saw a bid pulled sell-off in illiquid conditions, and so there was a dip below 46. And we knew these dips would be short-lived, sure enough. So the spot silver dip, I say dip, bid pull dip, sub 46 spot into the month and quarter end yesterday. Now, bearing in mind that 46 spot is roughly 46.17 in futures. So this futures trading around 17 cents higher. So, but that dip triggered enormous buying. It was readily bought, jumped on by Asian buyers overnight, and it drove another high, which was again sold into the London Open and again bought by Asian buyers. And what that did was overnight, and we're talking about Wednesday morning now, it drove another 2011, basically another 2011 high, which is actually the highest print since the all-time high. It was actually 48 and change in spot, but 49.820 in futures. Adding fuel to the fire, silver, that's the silver in CNH, which is essentially Chinese silver, is in massive demand, leading every other silver foreign exchange cross to all-time highs, euro, in every other foreign exchange cross. And given prices being discovered outside the CME LBMA ring fence, there's little doubt underpriced dollar price silver will exceed all-time highs. A lot of sideline money has come into play looking for cheap, underpriced dollar silver price silver, notably adding fuel to the fire, followed a large 370 tons of so-called non-delivery October contracts being called for physical delivery. And there's still 82 tons of non-delivery October silver that has to be loaded out the back door. And while we did expect this fight at 44,275, last line of defense, the liquidity providers indicated physical supply so tight resistance would be short-lived as short covering layers would be uncovered. And that's exactly what's going on now. Net of hedging supply, there is sufficient short covering fuel to drive a run into the next staging point of $53. So summing up, looking at gold as well, to see, it helps us to establish where the underlying paper market gold support is being disciplined. Following 20 consecutive fixes above 3,600 and then 10 consecutive fixes above 2,700, and now based on today's 4 consecutive fixes above 3,800, this constructive action is once again raising the physical support steps into another higher rally stair-step point. Each one of these levels were physically supported. Now, the spot silver dip sub $46, that's spot, into month and quarter end yesterday. We're recording this on Wednesday, and that was into the month end. And bearing in mind, silver is also a component of the OCC bets, which sit on the Fed's, in the Fed's hands. Nobody is short silver at this point other than the Fed. And guess what? They have no silver at all to actually repay this. So, well, guys, this poses just one final question. Has there ever been a better time to opt out of the debt-riddled fiat system? And all you got to do is just swap these debasing dollars, euros, pounds, or yen, whatever, for physical gold and silver. That's the only question. Are you doing it?
All right, that wraps up another episode of Live from the Vault, brought to you by Kinesis Money. And a big thank you to Andrew Maguire for sharing his deep market knowledge. And to you also for tuning in and being a part of this growing global community here at Live from the Vault. Now, if you're new here, make sure you hit that subscribe button, tap on the black bell right there so you'll be the first to know as each episode goes live. And if you've been with us for a while, keep helping us here by spreading the word give us a like, not now, but right now, and share this episode with someone who really needs to hear this, and get your questions into Andrew Maguire. Don't forget, you could have your question maybe be selected for next week's episode right here on Live from the Vault. And with that, we'll be back next week with more truth that you won't find on the mainstream media. And until then, buy physical and make sure it's backed 1-to-1. We'll see you next week.